Hello and welcome everyone. My name is Alex Shaw and I'm an Associate Director here at Progeny. We're really pleased you could join us for today's webinar, Confident Choices, Women and Succession Planning. Today, we'll be exploring the emotional side of succession planning, the key fundamentals and why having a clear plan matters. But before we get into the discussion, just a couple of quick housekeeping points. Today's session will run for around 45 minutes to an hour. This is a live webinar, anything could happen, and the recording will be made available after the event. We'll have time for Q&A today, so please do submit any questions you might have. We won't be able to provide financial advice during the webinar, but we will share general guidance and practical steps to consider. If you have any questions relating to your specific circumstances, then please reach out to your financial planner. It's now my pleasure to introduce today's panellists. First, Victoria Ross, Chartered Financial Planner, Chartered Financial Planner here at Progeny, based in our London office. Victoria has over 20 years experience in providing financial services and is a passionate advocate for supporting women on their financial planning journeys. I'm also delighted to welcome our guest panellist, Felicity Morris, Chartered Financial Planner at Carbon Financial, part of the Progeny Group. Felicity joins us from Carbon's Edinburgh office and brings a wealth of knowledge and insight to today's discussion. So without further ado, let's get into today's topic. At Progeny, we're committed to empowering the women we work with, both within our businesses and across our client community, to make informed, intentional financial decisions. This month, we celebrated International Women's Day, and this year's theme, Give to Gain, feels like a perfect starting point for today's conversation. It's a phrase that can mean different things for different people, but in the context of today's session, Confident Choices, Succession Planning for Women, it speaks to a simple idea that when you plan with intent, you gain clarity, direction, and more control over the future. And it feels especially relevant right now. By the end of last year, women were expected to have inherited around 60% of the UK's wealth, and globally, women are projected to receive up to 70% of the wealth transferring between the generations over the coming decades. That means women are increasing at the centre of decisions about family wealth, business assets, investments, and long-term legacy. In our work as financial planners, we often see how much thought, but also concern people bring to succession planning conversations, especially around family well-being, fairness, and the future. And many women in particular really lean into that side of planning. And that's really what today's session is about, to go beyond the technical side of succession planning and help you feel informed, supported, and equipped to make confident decisions for yourself and the people who matter most. So with Give to Gain as our backdrop, I'd like to open the conversation with our first question for the panel. Victoria, what does this year's International Women's Day theme, Give to Gain, mean to you and your clients?
Good afternoon, and thank you very much, Alex. So I've been thinking about this theme, Give to Gain, a lot since we decided to do this panel discussion. And what does it mean for me and my clients? And the concept I kept coming back to was the concept of balance. So I look at the women in my client base and actually in my life in general, and I see so much generosity. And that can be generosity with their time. So women are quite famously spread themselves quite thin with their time, balancing careers, balancing often the household, partner, maybe supporting parents, it can be children, supporting friends. Can spread themselves quite thin. So a key thing is to always make sure there is balance and that you're being looked after as well. And the same applies for finances. I see so much generosity in my female clients, wanting to look after often children, but generally those around them. So the examples I think about are the mother who wants to make sure that all her children get through university with no debt and potentially leaving themselves quite financially thin today. Or later down the line, wanting to help their children, say, pay down mortgages and maybe not quite looking at what the impact might be on their own financial security and essentially putting their children first. Or they want to help, but they are worried about that financial security piece and don't know what to do. So it's about finding balance. And I think that's one of our roles as advisors, to help our clients find balance. So that balance between looking after their today and looking after their tomorrow, but also looking after those around them as well.
Absolutely. Fliss, so from your experience of supporting clients, what feels most important for women to understand at this moment as they increasingly find themselves in the position of managing or passing on family wealth?
So, firstly, thank you for having me today, Alex. And I guess your question for me, from my perspective, I really want my women in particular to have some basic understanding around two broad principles. So, first being basic principles around investing and why it's so powerful. And more pertinent, I think, to today's conversation is just some of the basic rules around tax and how taxes work. So understanding these two basics can really help women feel empowered in a space where they have previously been excluded from, disappointingly. There is, of course, a point at which those basics might no longer serve you, where your situation is a bit more complicated and it warrants speaking to someone like us, a financial advisor or planner to help you. But unfortunately, what we have seen increasingly is that women are disengaging with their financial professionals. It may be that they have inherited an advisor who perhaps is looking after parents or their husband, and they haven't been so involved in conversations historically. So when it comes to working with a financial advisor, whether that's somebody you've inherited or speaking to someone for the first time, I'd encourage you to pay close attention to how you're being treated. So you want your financial planner to really listen to you and understand your goals. And are they doing that, or are they kind of brushing things aside and moving on to what they want to talk about? Are they pigeonholing you or condescending to you? You know, the classic thing is, you know, women are risk averse investors, which is I'm sure everyone can identify with that. But we know it's really disappointing that we often get pigeonholed that way. When there's plenty of evidence to show that actually women can be better investors than their male counterparts. Um, so those are the things that I want my women clients to really have an understanding of when it comes to thinking about these conversations around inheriting and legacy planning.
There's some really interesting research on women being better investors than men. I think that's a whole nother panel to talk about, isn't it? Um, yeah, I agree with what you're talking about regarding quite often women, if they haven't had any relationship with an inherited advisor, say when they've lost their husband, their husband's previous advisor, and then they end up disengaging from that advisor and no longer having advice. So my question actually to you, Alex, not to not to put you on the spot, but as a male advisor and an ally, you're here today as an ally supporting women and women's wealth. What does working with female clients look like to you, particularly on the topic of succession planning?
It's a really good question and a really valid question. I find I'm not going to do this by pigeonholing every male client I have as some sort of binary robot, but I tend to find conversation with women in financial planning scenarios tends to be an extended, more rounded, almost more holistic conversation where a lot more feelings about actions, consequences, how that may affect not only the direct, subjects of the conversation, but maybe extended family, children, grandchildren, etc. I think there's a lot more of an initial view and consideration about those things. So being able to have a slightly different conversation from a different angle, almost kind of painting more pictures, bringing more feeling into things, often seems to be the case. I also, from a personal context, encounter my greatest level of interaction at the moment with women in financial planning sadly from a more traditional aspect, where I've had a couple where the man has kind of been the breadwinner, as it were, and been the main conduit for those financial planning conversations. And maybe it just alludes back to that, the confidence thing, that maybe that initial view that women aren't as confident or don't take risks, that all comes with knowledge, and arming someone with the knowledge of what they're looking at and what it means means you can have a completely different conversation about risk, because yes, if you don't know much about something, then naturally you are going to be more hesitant to maybe take a risk. But I find once we can have a greater discussion, fill in the blanks, and the knowledge base is there, then we can actually move forward with just a more informed conversation that tends to be a lot better and a lot more accurate.
I appreciate you sharing the fact that your experience of female clients is quite often in the more traditional sense, as in part of a couple, because obviously women's relationship with money has changed so much. And you mentioned that women potentially have been disengaged from finances and financial services, and that's part of why we're here today and talking, because we want women to know financial services is a welcoming place for women, and we want to look after you.
Absolutely, 100%.
Thank you.
On to our next topic. So, succession planning isn't just a spreadsheet exercise. It's about people, priorities, and the future you want to shape. So it's completely normal for emotions to show up before anything else does. Our role as financial planners is to make space for those feelings, acknowledge them, and then help turn all of that into clear, confident decisions. And with that in mind, Fliss, why does succession planning often feel so emotional or overwhelming at the beginning?
Yeah, it's a difficult one because it's I think it's just a fact that succession planning brings up so many emotions. It may be the case that you're coming to speaking to someone like us, or dealing with succession planning for the first time after having inherited money, and whether that be from potentially a husband who's passed away, or parents who've passed on, leaving you a son that you didn't appreciate was coming down the track. So the first thing we're dealing with regards inheriting is grief. Somebody is going through a time of grief in their life, which is really, really difficult, even setting aside the financial side of things. Um, it may be the case that you're coming to that position of inheritance on the back foot, so you might not have been dealing with the family finances previously, so that's adding a layer of overwhelm to a situation where we've already got emotions running high. On the flip side, you might be just starting to look down the track at your own legacy and succession planning for yourself. And that really means confronting your own mortality. And I think that's something that nobody particularly likes to talk about, particularly in the UK. We're not so good at talking about it. We like to sweep these things under the rug, not tempt fate. Um, so that's quite a confronting process. Um, on top of that, when it comes to our kind of toolkit as professionals thinking about legacy planning, what we're often looking to do is lose control of some of that earned wealth, give it away, place it into trust, and that's losing control of something that you've worked really hard to build up on. So that's also very difficult. Um, and a nail in the coffin, so to speak, is the family dynamics that we're dealing with on top of that. So when we're thinking about your own legacy, do you have children who are in very different financial positions, perhaps based on whatever career they've chosen? Do they have very different attitudes to money? Have we got partners who've come into the family who were not so comfortable sort of having the family wealth pass on to? So dealing with those family dynamics on top of all of these emotions that are running pretty high, it's natural that this becomes a very emotional and overwhelming process.
So moving on from that, Victoria, how can those feelings sometimes influence decision making or even lead to delays?
Well, there's quite a lot of big decisions there. I mean, whether you're the person who's inherited or whether you're thinking about legacy planning, you could be dealing with something that you haven't dealt with before. And when you've got big decisions to make, particularly if you feel inexperienced in them, or they feel like they're very complicated, you just don't know which direction to go in. And so often when we don't know what direction to go in, we don't go anywhere. I mean, that's that classic rabbit in the headlights scenario. And add on top of that, with legacy planning, you talked about that sort of loss of control. Um, legacy planning can feel like a one-way street. You make a decision and that's it. But we'll talk about later some of the options and tools we have in our toolkit for legacy planning, and they're not all one-way streets. The other thing, though, that causes delays in legacy planning is that concept of, oh, I'm too young to be thinking about this. I've got plenty of time. And this can quite often happen from clients who are in their 60s and going, well, I'm going to live another 20, 25 years. Why do I need to think about this now? But it's never too early to take a look at what your position is and acknowledge how you feel about it. And also, time can be quite a significant factor in inheritance tax planning, particularly if there's quite a lot of work to do. It may need to be a bit of a multi-step process, so you need time to get all these steps into place. So the delaying through going, it's too early, generally isn't a good idea. Just start with taking a look at where you are and acknowledging how you feel about it.
Couldn't agree more. So, because we've been talking about give to gain, it's a good moment to look at what that means in practice. We know that many people want to support family or give during their lifetime, but also want to feel secure about their own future. So with those in mind, Victoria, what worries arise when it comes to talking about giving wealth away?
I would say there's three main worries that come up. Firstly, who are you giving it to? And are they ready? So are they responsible humans? Are they going to, put it towards something good or invest it? Or are they going to spend it on multiple holidays to Ibiza? So there's the concern about whether they're ready and responsible to receive wealth, and whether they feel emotionally ready to receive wealth as well. Do they have experience in it? Then there's also thinking about the people in their lives as well with that, are they ready? Do they have people in their lives who might take advantage of the fact that they've inherited wealth? So I'd say that's the first concern. Equality comes up a lot as well. And this is something I see actually more so with my female clients, the concern about what happens if, say, you've got children with different needs. One has, a significant mortgage to pay off. They don't want to be giving to one without giving to another, because there's the concern about that fairness aspect and what might happen after your days with that family dynamic. Is it going to stop the children getting wrong? Is it going to cause issues? The concern I think that comes up more than any is the what if I'm going to need it? And the key concept that comes up here is often, will I need it for later life care? Supporting my own health and well-being in the long term. And it's quite often quite a conceptual concern without really any sort of facts or figures around it. So you quite often see that clients will just hold on to everything for that just in case they need it. And this is actually particularly as well poignant for women, because we live longer and we are more likely to receive care. So those are the three main concerns I think that clients have.
And I think you both agree that it's becoming a more common conversation, sadly, this conversation about care and care costs. And like you say, sometimes we do need to be there to put a little bit of factual context into it, because it can seem a really kind of initially overwhelming subject, and rightly so. So it's another thing I think we really help to provide clarity and context to be able to take that conversation forward in a more rational fashion. But regards to the control aspect, Fliss, what does it look like to give in a way that still leaves you feeling confident and in control?
Yes, I think Victoria has teed me up really nicely here. So that sense of, well, I don't know what I need, so I'm just going to hang on to everything. I think the first thing I like to do with clients when we're thinking about legacy planning here and doing that confidently is establishing your own needs first. And a tool that we use as financial planners to do that is something called cash flow planning or building a financial plan. These sound like really jargonistic, businessy terms, which can be a bit sort of off-putting. But essentially what we're doing is pulling together a very visual thing that you can have a look at, which pulls together your desired lifestyle, accounting for some of those things that might be in the back of your mind as a concern, whether that's care, support for care costs in the home or at a residential facility. pulling that desired lifestyle together and projecting it forward and seeing how your various incomes and assets can come together to meet those costs. Yourself forwards for a number of years, potentially decades. So that requires us to make a set of assumptions about what's going to happen in the future, whether that's around investment returns, inflation, all of these sorts of assumptions we can build into the plan, and we can deliberately take a conservative, robust view on what these might be. So, for example, if we look at historic investment returns, we might dial those down a little bit when we're projecting things forward. When we think about inflation, we might assume that actually costs creep up a little bit more than they have done historically. And when it comes to your actual lifetime, we might expect you to live a little bit longer than average. And by making all of these conservative assumptions about what may or may not happen in the future, we can give you a real sense of confidence that you can financially weather whatever storm might come at you. And once we've established what you need, we then know what's left over. And that leaves us in a position to start planning for that legacy confidently, knowing that your needs are taken care of first.
So once the emotional conversations start to take shape, the next question we often hear is, okay, but where do I actually start? It's important to remember that you don't need to be an expert, but understanding enough to feel informed and in control can make the financial planning process feel much more manageable. So, Felicity and Victoria, in unison, can you walk us through the fundamentals, please?
Yeah, absolutely. So I think the first place to start here is to understand what various inheritance tax allowances are available to you on death, because that's when inheritance tax is charged. So I think you'll see on the screen there's quite a lot of numbers there. So I'll walk you through how all of these different allowances fit together, because understanding how these fit together enables you to understand what may or may not apply to you. So every individual in the UK gets what we call a nil rate band allowance of £325,000. So if you're an individual, unmarried with no children, and your estate is £325,000, there will be no inheritance tax due. However, if you're married, you've essentially got two sets of allowances, and you can pass these allowances to each other on death. So that's where we come to this combined nil rate band allowance of £650,000. Building on top of that, if you own property and have children, you've got what we call the residence nil rate bands of £175,000. And again, once we combine those for a married couple, we've got an additional £350,000 worth of allowances. So when we add all of these four allowances, if you will, together, we come to a combined threshold of £1 million. So that's where we often see that figure in the press, £1 million worth of allowances, but it's worth understanding how they interact, so you can understand how they work together. There are a few caveats here, as there often are. So regarding the residence nil rate band, once a combined estate is over £2 million, that residence nil rate band starts to get tapered down. So for every £2 over 2 million, the allowance gets tapered by £1. So the way I think of it is, once your estate is over 2.7 million, those residence nil rate bands have totally gone. There are additional allowances. So there are additional allowances for things like agricultural property, business property, and those have jumped around a little bit over the last wee while. I won't go into detail about them just now, but it's worth knowing that they are there if they're applicable to you. And then, broadly speaking, once we've tipped over these allowances, inheritance tax is charged at 40% of anything left over those allowances. So it's quite a chunky tax there.
Can you talk us through using the allowances that are available each year?
Yeah, absolutely. So that's the kind of position on death that we've talked about. But as you said, we've got allowances available to us every year. Now, before I go into all the various allowances, I really want to stress that there is actually no limit on what you can gift any year. It has knock-on implications, which we'll talk about. But there are no immediate tax consequences for either you as the person giving funds away, nor the person receiving them. So the first thing I want to talk about is the annual gift exemption. So every year, every person gets an annual gift exemption of £3,000. Now that can be carried back. So if it was unused in a previous tax year, you're able to do a double whammy in the tax year that you're in. On top of that, we've got something called the small gift exemption of £250 per recipient. Now that can be to as many people as you want, but you can't use it in conjunction with that annual gift exemption. On top of that, we've got gifts for marriage. So if your child, grandchild, friend is getting married, you've got a different set of allowances for gifting on those events. So it's £5,000 if you're a parent, £2,500 for a grandparent, and £1,000 to anybody else. And then on top of that, we've got something called gifts out of normal expenditure, which is a bit of a wordy one. And that's essentially saying that you can give away any of your excess income, and it's important to stress that it needs to be excess income. So what I mean there is you can't curtail your own lifestyle in order to be able to afford these gifts. That sort of fails the test. And on that point, it's really important that you keep good records just to make it much easier for your beneficiaries to be able to claim those allowances on your death. So that's the annual sort of gift allowances. But as I said right at the start, there are no fixed amounts that you can give. You can give whatever you want. All that happens is that for a period of 7 years, if you've gone over any of these allowances, those gifts are sort of kept on your balance sheet. It's worth saying that people often see that as some sort of hesitancy to do something, but you're in no worse position for that 7-year period. And then once we've ticked over that 7-year period, you've got all of your allowances available again, and you're ready to go.
Yeah, I quite often see that clients feel that 3,000 limit is a limit,
Exactly.
and they can't do anything more than that. So it creates that kind of rabbit in the headlights that I talked about earlier.
Yeah.
So that's gifting. Victoria, what can people think about doing other than gifting?
Yeah, as I mentioned, we do have some other tools in our toolkit. So the sort of things we'll talk about. So first one might be life cover. So this is an option for those who want to make sure to increase essentially their legacy, or to make sure that inheritance tax liability is paid. So there's liquidity in their probate situation to pay down that tax without having to worry about selling property, for example. So life cover, it could be for whole of life. It could be for a certain period, like 10 years, 20 years. Obviously, there's a premium to pay. But I generally find life cover can be quite good for those in the earlier stages of their wealth journey. So they're still working, they don't quite know when retirement's going to be, what it's going to cost them, how much they're going to have, because it's one of these essentially reversible decisions that we talked about earlier. But for the clients who are ready to start moving assets out of estate but don't want to gift directly, say some of those, because of some of those concerns I talked about earlier, that's where trusts come into play. So a trust is essentially, it's a legal structure where the settlor gifts into that trust, and then the trustees look after that gift on behalf of the beneficiaries. So they will, the trustees will make the decisions on how it's managed, and importantly, how it's distributed and when it's distributed to the beneficiaries. And the settlor can be a trustee. So it's a way of gifting whilst retaining a level of control, say around timing of gifting. There are also trusts where you can retain a level of income from what you've gifted into the trust, or even access to capital. But these trusts are generally, I'd say, some of the most esoteric stuff that we deal with. So we're definitely, with that flexibility comes some complexity. So it was definitely moving into speak to an advisor territory on that.
Absolutely.
Fliss mentioned business relief allowances earlier. So business relief, the government incentivises us to invest into either unquoted companies or AIM shares by giving inheritance tax relief after 2 years. So plenty of legislation change around this at the moment. As of April 26th, business relief. So the unquoted companies have a 2.5 million allowance where you get a full 100% relief, and over that you get 50% relief. AIM shares, so AIM Alternative Investment Market shares, they're just 50% relief, and that's the end of it. So you get that relief once you've held these for 2 years, but you do need to hold them till your end of your days. So I would say because of that, and one of the good things about it is it's that right to change your mind. So it's quite good for those clients who've got those concerns about, will I need it for, say, cost of care in the future? Because it stays in your control. You can sell out of them, and then they're there to finance care or other should you need it. But because of the idea is that you're meant to hold them until the end of your days, I tend to find I generally start talking in earnest about this stuff when the clients get to like their 70s or so.
Yeah, definitely, because we're dealing with that 2-year clock rather than a 7-year. It's definitely later down the line.
Yeah, definitely. Victoria, do you talk to your clients about wills and powers of attorney?
Oh yeah, absolutely. I mean, because financial planning is about not just our days, but what happens after our days. And wills need to reflect where we want our estate to go, after our days, who our beneficiaries are. And if you don't have a will in place, then your estate is subject to the laws of intestacy. So as some examples, if you're single and no children, your estate actually goes to your parents, which is possibly not ideal. And if you cohabit with someone, and you can live together, you could have children, but you're not married, not in a civil partnership, and that partner gets no protection at all. So everything, if he had children, everything essentially, and the children are minors, goes into trust for those children, which again might not be ideal at all. Now, Flish, you keep reminding me the laws are potentially different north of the border.
Yeah, it's worth saying that if we do have anyone on the call, sort of north of the wall, the rules around intestacy are quite different in Scotland. So it's worth, and on top of that, if you've perhaps moved north but you have an English law will, it might not hold up if you died in Scotland. So it's worth at a point of moving, or if that's where you live, it's worth speaking to a Scots law qualified solicitor.
Thank you. So, as part of that conversation about wills, I will generally start the discussion on the sort of trusts one can have in their will. So the two main ones that solicitors will talk to you about are you can have a life interest trust, where essentially if you pass away, all your affairs can go into a life interest trust on behalf of your spouse. So they can still, utilise their income and capital potentially from that trust. But after the end of their days, it goes to your desired beneficiary, so your children or other. And what this does is it prevents, it makes sure that your wishes are still adhered to if, say, your spouse remarries and has 10 more children. So it makes sure that your wishes are adhered to. And the other trust that often goes into wills is a discretionary trust, and that's to protect the beneficiaries from themselves, really. So what happens is, if, say, so you pass away and everything goes into trust, if any of the beneficiaries are in an irresponsible place, say bad with money, developed a gambling habit, something like that, or are in a bad relationship and they're just not ready to receive an inheritance, that inheritance can stay in trust until they're ready. But if everything's fine, it can be paid straight out again. So that is really, for me, where the conversation will end, because we really are in solicitor territory with wills.
Yeah.
But what we'll do is we'll introduce them to some of our in-house solicitors, and we can even be involved in that conversation as well. So we've got all that joined up thinking. So their lifetime plan, is cohesive with what they want after their lifetime. You did mention lasting powers of attorney as well.
I did.
Yep. So it's a good idea to be thinking about lasting powers of attorney when you're thinking about your wills. So wills look after your estate after your days. Lasting powers of attorney look after your affairs if you lose capacity. We generally associate loss of capacity with older age, but things can happen. Accidents can happen. You can lose capacity for things other than, say, dementia. So it is a good idea to just get those ticked off. So they essentially, a lasting power of attorney means someone can make decisions on your affairs. And there's two main types. There's the health and welfare one, which is that you can make the final decision on how you're looked after and where you're looked after. And there's a finance and property one, and I'd say that really is the important one to have, because often what people don't realise is even if you're married, if someone were to lose capacity, your spouse cannot access your accounts, your investments on your behalf without that lasting power of attorney saying you've given them power to. So yeah, really important thing to have as well.
I think it's something to remember as well that capacity can not only just refer to mental capacity, but it can sometimes, particularly with the older generation now, come down to a fact that if somebody actually loses the physical capability to go to the bank to do their banking and they don't do internet banking, that somebody else might be required to do that for them. It can be something as utterly simple as that. And again, I know we're terribly British and don't like to tempt fate or do anything like this, but I'm sure you'll both agree with me that it's just sensible planning to have these things ready. So if we're going to take anything away today, it's that it's none of it's tempting fate. These are all sensible steps to take.
Yeah, absolutely.
Moving on. Something we hear again and again is that the hardest part isn't necessarily making decisions, it's taking the first step. And that's perfectly normal. The encouraging bit, you don't need a grand plan to make progress. So, Liz, what does a realistic first step look like for someone who's just starting to think about their succession planning?
Yeah, so it's a really basic, easy first step in my view. It's just write everything down. So write down everything that you own, include cash, pension pots, which will be included in the pot as of April next year, properties, any investments. How much do these all add up to? Think about your own circumstances. How many of those allowances that we've talked about, the nil rate bands that we've talked about, how many of those apply to your circumstances? Once you've got a grip of those two things, you can work out the rough bill. Once you've written everything down, particularly if you're perhaps DIY, not working with a planner so far, think about how these numbers are going to change. Is it the case that you're expecting potentially more money through inheritance? Or do you expect on the flip side that you might spend this wealth down over time? So how is that number going to change over time? Then once you've got an idea of what the position is, what the tax bill is, if you will, how do you actually feel about it? It may be that it doesn't bother you so much. That it may be that it bothers you loads. And we've talked about inheritance tax being 40%. That's a chunky number, nearly half. But if we were taking some easy numbers, a straightforward estate for a married couple of 2 million, that's an inheritance tax bill of £400,000. So based on the whole estate, that's not 40%, that's 20%. If you've got perhaps 2 children that you're passing that wealth on, do you think of it as 10% per head? So start turning these ideas over in your head, and just to understand how you feel about them, and how much they bother you, how aggressive you want to be about planning around these. Once you've got an idea of how you feel about it, and then on top of that, start to think about who you want to benefit from the wealth. So is it children? Is it charities? Are there other things that you want to think about? Do you want to help now, or are you happy to leave it till later? When is it going to be most useful to the people who you care about? So just start thinking about all of these different ideas, not necessarily because you have to do anything, but if you have an understanding of how you feel about it and what the position is, you're able to then progress and take that first step.
Yeah. What do you have? How do you feel about it?
Yeah.
So, Alex, what would you say to someone who feels like they should start legacy planning but is just going, well, I don't feel ready yet. Now's not the time. Maybe I'm too young. What would you say?
I have a perfect example of that, and that would be me. So, 3.5 years ago, I was a perfectly healthy, reasonably athletic 45-year-old father of 2 who I'd never smoked, and was training for the London Marathon when I was diagnosed with lung cancer. And obviously 3.5 years later, something went reasonably successfully because I'm still here. So thankful for small mercies. But it got to that point when, yes, you start to consider your own mortality, which isn't something I intended doing at 45. So all of a sudden, the focus does shift to, okay, well, everything needs to be in place. So I'm now the proud owner of a valid will and both types of powers of attorney. A mega spreadsheet containing all my account numbers, investments, addresses, email addresses, everything, so that's there almost as a point of reference for someone should they need to read them. And it was one of those things. Yes, it was brought about by sheer necessity, but then made me think. People confuse wills with passing down wealth and all these issues, when it can be simply come down to something like, well, who's going to look after my kids if I'm not here? So it was things I hadn't even thought about in the normal context of life. And obviously, if the treatment hadn't gone successfully, I may have needed to, have a power of attorney and vote for someone to act for me if I'm incapacitated. So all those things were really, really relevant. And I would just say none of us know when too late will be, and I don't think there's no such thing as too early. As I've said before, it's just sensible planning. So if you can do it, do it.
It's worth thinking about it. Like insurance, nobody doesn't insure their house because it might mean that a flood happens.
Absolutely.
And so it's just good insurance, really, isn't it?
It is. When you look past all the policies and paperwork, succession planning is really about meaning. It's about what matters to you, the people you want to look after, and the impact you want your wealth to have in the long run. So with that in mind, what role can charitable giving and philanthropy play in shaping a meaningful legacy?
Shall I take that one?
Go for it.
So if you gift to a UK registered charity during your lifetime, that gift will never be subject to inheritance tax. So even if we lose you in the next 7 years, no inheritance tax consequences. And also via what's known as gift aid, you can also reclaim basic rate tax through that as well. Now, if you leave to charity in your will, that is also not going to be subject to inheritance tax. But if you leave more than 10% of your net estate, so net estate means your estate less the allowances we talked about. If you leave more than 10% of your net estate to charity, you also get a reduced inheritance tax rate. So that 40% becomes 36%. And the outcome of that is the estate you leave to your other beneficiaries is actually only often marginally reduced. So it has quite a powerful impact, and it's useful particularly for those who just want some control over, a bit more control over where their estate is going to, potentially have some strong views about leaving money to HMRC, and would just rather direct it to a favourite or many favourite charities instead.
Fliss, any points to add?
Yeah, so where I often see sort of philanthropy coming into legacy planning like this is working with charitable trusts. And where I've come across these sorts of cases sometimes where people don't have children, so there's not necessarily that natural sort of pot of beneficiaries, if you will. And there can be a sense for those potentially without children that, oh well, I'll just pay the tax, and that's absolutely fine if it doesn't bother you and you're happy to do that. But it might be just the case that you don't know that these charitable trust setups are available. So what you can potentially do with a charitable trust is pass funds into trust with a view to be able to distribute those to various charities, sort of UK registered charities. So the way I've seen those set up is where the person donating the money, the settler, passes money into trusts and involves people close to them, and if those are available, so potentially nieces or nephews, for example, as additional trustees alongside them. And that's really a way of kind of letting their legacy live on in a way that's important to them. And it's particularly powerful where you're able to direct those trust funds to perhaps some smaller, more under the radar charities. We can all think of big hitter charities who are kind of natural homes for legacies and wills, or regular contributions. But there are lots of other sort of smaller under the radar charities which might have a specific place in your heart, that you can really target support at, through these sorts of charitable trusts.
Thank you both. So, as we move into this final part of the conversation, it's a good moment to pause and think about the difference planning can make. Starting early, even in small ways, often shifts how people feel about their decisions, their options, and the future they're creating. Let's talk about what those changes can look like in real life. Victoria, when you're working with clients, what difference does professional support make to these conversations? And what kinds of benefits do people tend to notice once their plans start to take shape, particularly when younger family members are involved at an early stage?
Okay. So, I mean, I'm a big fan of having family members, the next generation, involved in these conversations wherever it's appropriate. We can be very British about these things and not want to discuss money with family. So, I mean, it is down to the family personal choices. But where we can involve the next generation, there's lots of benefits for that. I mean, firstly, there's the comfort factor, the peace of mind that this is being addressed. The legacy planning, inheritance tax, it all is being addressed. And also as well, given that quite often when we're talking about legacy planning with our clients, quite often those clients can be of, say, let's call it a vintage age. So the next generation is going to have some comfort that they are being looked after, and being talked through decisions and making appropriate decisions, and just have comfort that they're being looked after in a suitable way. And then I'd say the next step along is it prepares the next generation or your beneficiaries for inheritance, where they might not have had any experience with wealth or investing before. And we know that women do tend to have less experience of investing statistically than men do. So having them involved, the beneficiaries involved in the conversation, prepares them both for that receiving of the inheritance, but also gives them visibility of that inheritance tax position that is potentially still going to be there. And I think the last piece of that puzzle is that when the time comes, and it often is when it's in receiving inheritance for estate, it's at a difficult time. So if you know the family advisor already, the person who has been looking after the affairs, looking after, your parents or other, it's just one less thing to worry about during that difficult time.
Yeah.
So I'd say wherever possible, involve the family members in the conversations and introduce them to your advisor.
Absolutely.
How about you, Alex, in your experience as a financial planner? What have you learned about supporting people through these big financial decisions and life transitions?
I think the main thing that I've learned throughout these processes is to involve everybody who's a part of that process, be it at the beginning, in the middle, or at the end. Make sure as many people are in the room as possible who may be affected by these decisions and this planning. Keep the dialogue open, so make sure people are all aware of what's going on as situations change. And also, never be afraid to give your professional two penneth worth, as it were. Actually value the experience that you have as a planner and what you can bring to this. You are often the trusted aid, the confidant. And above all that, you're the rational one who's actually not emotionally involved in something, so you can bring a level of rational clarity to matters. And I always find that, yes, as you both know, when you're involved with families for a significant length of time, you do become kind of immersed in that family, the family scenario and all the different moving parts of what goes on. But I think it's good that we can retain that level of professional objectivity and stand there as that almost beacon of rationality in everything sometimes. So yeah, they're probably my biggest takeaways in the memory bank from my experiences.
Yeah, especially that point around the kind of the rational. There I don't know about you, but I've got 1,000 things that I worry about which are irrational. And if you can take some time to speak to someone who experienced and knowledgeable and who's done this 1,000 times and understand what is a valid concern and what isn't, um, then that big 1,000 list of worries can just be kind of whittled down a little bit, and you can focus on making the right decision, you and your family.
Well, it's been a brilliant conversation today, which I hope you found useful. We've covered a lot, but good news, we do have time for a Q&A. So let's look at some of the questions you've been asking. And you can tell it's live now because we have to go live to the nerve centre and have a look. So, yeah. Okay. What's an easy way to start planning for the next generation? Who'd like that one?
I'll take this one because I've got a nice nerdy answer for it. So my favourite way to start sort of dipping the toe into that legacy planning, if that's what we're doing, is to start talking about potentially making pension contributions for a third party. So perhaps you're a grandmother in her early 60s or 70s. What I'd encourage you to start thinking about is perhaps planning for those grandchildren. And you can do this in quite a small but powerful way. So if we think back to those annual allowances we talked around gifting, we've got that annual gift exemption of £3,000. And we know that for someone who's not working, so potentially that 2-year-old grandchild that you've just got, they're able to pay into a pension pot when you're able to do it on their behalf. And your net contribution to that pension pot is really handily just inside your annual exemption for gifting. It's £2,880. So on top of that, the tax relief on that contribution is £720. So if you say committed to doing that for your grandchildren for a period of 10 years, that's a cost to you of £28,800 over 10 years. Well, that's immediate tax relief to the recipient, to your grandchild, of £7,200. And if you can only imagine, if we add in the period of time that we're dealing with when we talk about a pension, as a minor, you're not going to be able to access that pension pot for decades. So once we've added in compounding investment growth on top of that, you can be planning for well into a 6-figure legacy for your grandchildren, at a cost of £30,000 less than. And on top of that, we've got that element of control kind of inbuilt, because we know that that pension pot can't be accessed until your late 50s. There's no chance of your grandchildren, spending that money on a car or a trip to Ibiza or something that you're maybe not so comfortable with. And on top of that, you've got that immediate and inheritance tax relief because we're within that annual gift exemption of £11,000 plus. So it's a really small but powerful way to start planning for the next legacy without sort of committing yourself too much.
Yeah, people often don't think about pensions for minors because it's junior ISAs that comes up more than anything. And I mean, there are some great stuff about junior ISAs. Obviously, it's a whole other ISA allowance. But the thing that parents, always going to remind parents that they do have access to it when they are 18 to do what they want with it. So you need to make sure that you're okay with that. I do like the concept of our young adults, our sort of 15, 16, 17-year-olds, having some investment experience though, because it's a bit of a minefield out there now because when you turn 18, anyone can get a trading account. And obviously social media is absolutely littered with, get rich quick trading. So for them to have experience at least experience and knowledge of investing from a young age, it's just going to help protect
Really
them.
powerful, yeah.
Right. As a woman in my 50s, start to think about financial advice. What should I look for in an advisor to feel comfortable they'll support me in the right way?
Shall I take that one?
You can take that one.
Yeah, I think that's right up my street. So when you're talking to a prospect advisor, what are they asking you? Are they asking you about your goals? Are they asking you about your family? Are they asking you about your dreams, your fears, what you want to achieve for the future? Do they care about you? Or are they just asking about your investments? So that's a key thing. Most advisors will give the first meeting, that sort of initial chat to get to know them. They'll do that at their cost. So there is absolutely no harm, and in fact, I strongly encourage this, to go and talk to a few different advisors. The advisor-client relationship could be one that spans decades. So for both client and for us, there's a massive benefit if we get on with each other. So speak to a few, find something that fits. And I would also say my message to female, potential clients: if you do want to work with a female advisor, it's okay to ask for one. Unfortunately, there's not enough female advisors out there. But if you want to work with a female, do ask for one. And we quite often see this. And by the way, I'm not saying that our wonderful male advisors cannot look after ladies. You absolutely can. But quite often see that when ladies, particularly if they've been through something like divorce, they're just going to feel more comfortable and more open, and just feel that potentially a lady understands what they're going through a little bit more. So it's okay to ask.
Absolutely. You've got to do what feels right for you.
Yeah.
And there's no harm in at all going and let's say road testing as many as you can be, but it's got to feel right.
Yeah,
And
the
hopefully
chemistry is really
it's going to be hopefully 10, 20 plus year relationship. So you've got to make sure you start with something that you're comfortable with from the outset. I think we've got, looking at the time, don't want to overrun. We've got time for one more. So what's the best way for couples to get aligned on succession decisions when one of us has always been the default decision maker? Well, you two have got to answer one, so I suppose it's only fair I get to have a go, isn't it? Yeah, this is a good one. I would sometimes, it almost feels like you're not doing some sort of police interview, but genuinely would make people note down their objectives separately. Almost, if we're used to having one voice that's more louder than the others, let those two people think independently and think what they'd actually like to do, and almost bring that to the table when I'm there, so that you don't feel like I'm some sort of mediator. But I suppose I am, and I'm the sounding board, and I'm the person that then they can both feel they're putting valid points to. So maybe they're not comfortable with saying them to each other. Who knows in relationship dynamics how it may go. But if I'm there as they're not almost telling the other person, that they're telling me, because I need to find out as much as I can about that family dynamic and the situation and everybody's objectives. So this sometimes in my kind of client base comes to the fore when we start to talk about retirement planning decisions, because all of a sudden someone's not at work all those hours and starts invading the house more often, and you can see that shift in dynamic and literally the shift in relationship dynamic before your very eyes. And I think that's when the balance starts to reset. So for me, it's always making sure, both voices should be heard throughout that journey, regardless of, you're both part of the team, you both made the home and the life work in whichever capacity you've occupied over time. So I would always encourage during a meeting anyway, that both people get to speak up. But for me, that's one of the key things that and both people then, when I've gone, continue to talk to each other, continue to have that dialogue. And it's lovely then, ideally for us, if you can come with a united kind of household objective of this is what we want to do. But sometimes it's got to be a little bit of, well, here's what I want and here's what I want. And as I say, input all into me, and then we can go forward with something that works for both people.
Yeah, and I think it's just the opportunity, the kind of safe space, if you will, to talk about these things. It's so easy in day-to-day life. Maybe you're at work, maybe you're tired, you're busy having your life, not necessarily thinking or having the opportunity to just sit down and talk about these things and see how you're feeling. And I'm amazed at how often people have spent an hour with us as financial planners, and then a week later, a couple of weeks later, it's like, oh, we've done so much more talking about it
Yeah.
after having had the opportunity to bounce ideas around as a team,
Yeah, and I so often find at the first time, when we meet a couple, say, for the first time, it can be the first time they've had those discussions and had no idea about each other's goals and objectives. And yeah, part of what we do is making sure they are both heard, their views are both validated, and we walk them through, the pros and cons of all the options, just bring those views together.
That last question brings to the end of today's session. We really appreciate you taking the time to join us, and we've genuinely enjoyed the conversation. Before we finish, I'm going to pop the feedback QR code on screen. We'd be really grateful if you could take a few minutes to share your thoughts on how you found today's session. If today has raised any questions about your own planning, please do reach out to your financial planner. And if you're new to Progeny and would like to speak to someone, just let us know via the feedback form and we'll be happy to arrange a follow-up. We'll also share the webinar recording over email in the next day or two, along with some useful resources if you'd like to explore the topic further. And with that, I'll say thank you again, and thank you again. Enjoy the rest of your day, and we hope to see you at another webinar soon.